I think alternatives will continue to be a viable investment. This is the most amazing job that exists. I know you think your job is great. My job is far better.
Kim Lou took a long journey just to get back to where she started.
I was born here in Harlem, so it feels like I've come home.
The recently appointed head of Columbia's $13.5 billion endowment was born roughly a mile from the school's campus, but few people in her neighborhood aspired to the Ivy League.
I didn't just grow up in the Bronx. I grew up in the housing projects in the Bronx, and there was very few people that went to college, let alone go to a college like Penn.
From Penn, Kim headed to Wall Street, then Harvard Business School, and eventually landed at the Ford Foundation.
To say she is a trailblazer is an understatement. Kim Lou has worked in a field that has had very few women and even fewer African-American women.
Kim's career took off when she went to the Carnegie Corporation, where she rose to become the CIO of its $3.5 billion endowment.
I wasn't surprised by Kim's success. Kim was destined to be a leader, to be great, because she works hard.
Now at Columbia, she has her work cut out for her. In recent years, the school's investment office has lagged its Ivy League peers.
We're going to run through that wall, and we're going to set this institution up for the long term.
We're on the campus of Columbia University with Kim Lou, who is the relatively new Chief Executive Officer of the Columbia Investment Management Company. Thank you very much for being with us.
Thank you for having me. It's a pleasure.
Now, why do universities have such big endowments? They all seem to be bigger and bigger than they used to be 20, 30 years ago. Why do universities need these big endowments?
Well, you know, the university's endowments are used both to fund issues that are occurring today and students today, as well as the future, and the number of different types of activities and a number of different types of research they are trying to support. Those issues are growing every day. For instance, Columbia University is trying to tackle the climate issue, no small endeavor. So they have a lot of research behind that, as well as a number of students that they need to support in order to find the solutions to these big, massive problems. And so the endowments grow to support the needs to solve some of these big problems and to educate the students that are going to be the leaders of tomorrow.
Now, typically, a university takes a certain percentage each year out of the endowment to pay for operating costs. It's maybe around 4 to 6%, somewhere in that range, and that's what Columbia does?
Yes.
So you need to make at least each year, I guess, at least 4 to 6% or whatever your ratio is. Is that how you operate, to make sure you have at least that amount?
Yeah, you know, the universities, when we think about ourselves, we think about what the payout is, and the board determines what the payout is. We are not involved in that. But when I think about what is important for me to be successful in my job, is that I want to make sure I can get that payout plus whatever inflation exists, because to pay for that same student a year from now will be more expensive than it was to pay for them this year.
Your job is to make certain that the rates of return are as high as realistically they can be. And the rates of return have been very good for all university endowments recently. Is that because the investment managers are so smart, or the markets have been pretty good?
It's a combination. I mean, we hope that we are picking managers that are particularly smart and doing even better than the markets, but the markets have been strong, and it has a lot to do, I think, with both a function of the fact that there's so much technology that makes it more efficient to do a lot of things, and introduces a lot of new ideas and a lot of new opportunities. But on top of that, you know, all of these things are relative investment decisions, right? And so there was a time when people were making absolute decisions, and the option of investing in bonds existed, but now everyone's looking for equity options in order to meet their returns. And so they're making a lot of relative decisions about the best places to put their money. And so that means all the good ideas get bid up. And so there's just a lot of money out there managed by institutions who have high return hurdles that are looking to invest. And so you see some of the best ideas getting more and more expensive.
So do you manage your endowment in-house, or do you use outside managers?
We use outside managers.
So when you're hiring managers, are you looking at their track record, their diversity, their commitment to ESG? What is it that you're looking for?
So I start with looking at their strategy. Is their strategy unique? Does it offer the opportunity for them to make outsized returns? Then I look at their organization. Have they created and built an organization that supports their strategy and makes sense? Then I look at their alignment. Are they aligned with me and Columbia, this institution? And are they treating us as partners? Do they have high integrity? Are they committed to the values that we are committed to? And are they thinking about the long term in the same way that we are thinking about the long term? We then look at the track record to support whether or not the analysis that we've done about all those other things have been shown to be true. Because a lot of times people start with the track record, but track record just tells you what they did with the circumstances that existed in the past. I want to know what they will do going forward. So let's just think about what it takes for them to be successful going forward. And then I look at the track record to see if they have those skills. In that environment, did they do what they were supposed to do?
So let's suppose you decide to invest with manager A or manager B, and they make a great sales pitch to you, and they have a great track record, they're good on ESG and everything else, and they're Columbia graduates too, everything you want. But the performance is not good after 1 year. Do you say goodbye, or do you give them 2 years or 3 years? How long do you give people?
For me, it's always, is the underperformance explainable? Because every strategy has a good time and a bad time, right? So just because they are underperforming the market doesn't mean that they are not a good manager. So if I choose a manager and that manager is a value manager, and value is out of favor and growth is performing, so if I look at them relative to value managers, they're adding a lot of value and they're doing great work. That's different than if just because they're underperforming the market doesn't mean they're not good investors. We choose managers for specific strategies. So we want to look at whether they are performing appropriately for their strategy. Was the reason they're underperforming for an odd reason, idiosyncratic risks that was not predictable? And yes, they underperformed, but they recovered from it really strongly. You give them more time. So it's a matter of understanding what created the underperformance and whether it's something that we think shows an erosion in their ability to outperform. If it doesn't, you stay committed. That's one of the things that we have the benefit of doing because we have diversified portfolios. Each one plays a different role, and so we don't expect them all to perform at the same time.
Now, in universities, sometimes alums and others say, well, universities should disengage and not invest in, let's say, oil or gas or other kinds of things that are socially controversial. How do you deal with those issues as the university chief investment officer?
So when I think about it, I think that it is very important for the investment arm of any institution to be aligned with the values of an institution. On the other hand, as a chief investment officer, as a chief executive officer of the endowment, I want to have as few restrictions as I possibly can because my principal goal is the return. But I don't think that we can do that at the expense of values. And so Columbia has been very clear that they have a value around sustainability. They have a climate school, they have an Earth Institute. I think when the Board of Trustees made a decision to commit to solving this world problem, they decided it was a value of theirs and it was important. And so when I was interviewing for the job, they made it clear to me that that was something that was coming and that it was important, and I didn't argue about it at all because, of course, I want to make sure that the endowment is managed in a way that it is completely aligned with the university. Having investments in things that probably won't mature for 10 or 20 years is fine because we expect to be here in 10 or 20 years.
College endowments have changed a lot since 1638. That's when an English minister in America named John Harvard died and left his library of 400 volumes and a sum of £779 to a college established by the Massachusetts Bay Colony. In return, the grateful colonists called the college Harvard. Fast forward to 1985. The colleges known as the Ivy League led higher education when it came to endowments. But, some would argue, their investing styles really weren't that sophisticated. At Yale, David Swensen inherited a $1 billion portfolio that was 40% invested in bonds and more than half in U.S. stocks. Over the next 35 years, Swensen transformed the way colleges invested their money by focusing on reallocating assets into non-traditional asset classes. And Yale's endowment grew from $1 billion to $32 billion, even as it was making regular disbursements that allowed Yale to transform its campus. Swensen died in May at the age of 67, but its legacy remains. Universities across the board have reduced dependence on stocks and bonds and moved into alternatives. Across all endowments in 2020, only 12% of holdings were in fixed income and 33% were in global public equities. The rest of the portfolios were focused on alternatives, private equity and venture capital, marketable alternatives, and real assets. It's a mix that the endowment chiefs of the mid-20th century wouldn't have recognized. When university endowments were first starting, and let's say in the early part of the 20th century, they were very modest, but gradually they began to invest in more than fixed income and bonds. And I think Harvard might have been one of the leaders in going to equities in the late 1950s. Now everybody is not just in fixed income and not just in equities, but a large percentage are doing what's called alternatives. Why are alternatives such an important part of the endowment process right now?
Yeah. So increasingly, alternatives are not alternatives, but they're core parts of the portfolio. They were considered alternatives at one point because it was unusual for people to invest in them. And they're particularly a great investment for a foundation or an endowment because they are a long duration asset. You can't get your money back right away. And so it really is an investment for the future, and much about an endowment is an investment for the future. And so it's a great opportunity for us to leverage the fact that we're long in nature. Columbia University expects to be around for hundreds of more years. And so having investments in things that probably won't mature for 10 or 20 years is fine because we expect to be here in 10 or 20 years.
Let me ask you about the investment world today. Many people are excited about cryptocurrencies. Do you have a view on that?
I think it will have profound effects. It may not. There are many different avenues that it can go. There's stable coins, there's NFTs, there's just the blockchain, the different layers. People are using it for so many different things. I think clearly it's here to stay, and I think clearly it's going to play some role. Not clear what role it will play. And so for us, it's important for us to dabble a little just so that we make sure that we follow. Make sure that we have relationships with people who are going to develop expertise and we can leverage those expertise to decide which way to go. It is not something that we would invest a lot in at this point. You know, there's a lot of volatility, there's a lot of risk, which is not something that we're necessarily getting paid for right now. But for sure, we have the ability, because we are long-term investors, to explore new roads. Right. And so cryptocurrency is one of them.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
Yeah. I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long and a persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
What about debt? The U.S. government has a lot of debt, like $28 trillion of debt. It's adding about $3.5 trillion a year. Does that worry you? You
know, for a long time, I thought to myself, I was worried about the debt because of the potential impact on inflation and the value of the dollar. But I wasn't super worried about it until you have capacity constraints. We're starting to see capacity constraints which have a much larger impact on inflation. So as far as inflation goes, that's a mounting worry. But the issues around the dollar and the sustainability of the United States and reliability of it, and whether other governments and other places and markets trust the United States, because we do have, the currency is just backed by the promise of the government. So they have to believe in the government. I think we continue to have a place in the world where people feel confident about us, but there are other powers rising every day, and there's other people looking around and trying to make sure that they also have a place, a vocal voice in the world, and we have to be conscious of that, and we have to be careful. And so I think the debt level is something that we have to watch and pay attention to. But if you can print dollars, you can pay your debt.
So let me ask you today, as you look at the investment environment, what makes you the most nervous and what makes you the most optimistic?
I think I'm most optimistic always about technology and how technology is solving so many of the world problems. I do believe that we're going to see solutions to the climate issue. I do believe that there are going to be solutions to lots of medical issues, and the biotech field is awash with wonderful opportunities and brilliant people solving problems. So that makes me incredibly optimistic. I think I'm most pessimistic about the fact that there are so many large world problems that are not things that we as investors can predict the outcomes of. And so since we can't predict the outcomes of these sort of big global geopolitical issues, we're trying to invest around them and trying to hedge as best we can. But it's hard to predict. So, do I think a lot about what is the relationship between different governments? I think a lot about that. Do I think a lot about the point we talked about the rising debt levels and the impact that will have on the long term and the stability of the economies? Investing implies a level of predictability. It implies a level of trust, and it implies an ability to analyze. So many of these problems are so idiosyncratic and so not predictable, and we don't control the outcomes. And so that worries me. If you want to produce return, you have to be willing to take risk.
Right now, if you want to buy a stock market index, you can easily do it, or a fixed income index or something. But suppose somebody says, I want to replicate what Columbia does or some other great university in their endowment. There's no way to buy an index that reflects that, is there?
Not currently, although there are people out there who are trying. There are people who are out there trying to pull apart all the different components of value creation in a private market and create baskets or structures that allow you to leverage all those different opportunities. It's challenging. People are working at it. I don't know that I believe that someone has it exactly figured out right now. And also, I don't think you want the median or the average performance in a private structure. You don't get paid for the fact that you've locked up your money when you do that. What you want is to invest with the very best managers. And so that requires active investment versus passive. So I think there are people out there trying. I think it's going to give retail clients the opportunity to invest in some of these opportunities, but it's probably not the way that an institution will approach that market.
So before COVID, there was a thing called cocktail parties where people went to cocktail parties and they talked to each other. When you go to a cocktail party now, and they're coming back, do people say, well, you're in charge of the Columbia's investment endowment, give me some stock tips, or what do you think I should do with my money? Do people ask you for advice all the time, or you just tell them you're only specializing in Columbia and you don't tell them what to do?
I say, the cobbler's children have no shoes. I am an institutional investor. I'm not a retail investor. The risk tolerance of a Columbia University and the duration of a Columbia University is very different than the individual. So I don't give stock advice or market advice.
So let's suppose I said to you, what is the best investment advice you've ever received? What would you say?
I think the best investment advice I've ever received is the fact that we are in the business of taking risk. And so if you want to produce return, you have to be willing to take risk, and you have to be willing to analyze and mitigate that risk the best you can. and to make sure that the return potential of an investment is equal to the risk, but you can't avoid risk.
Okay. Now, what do you think the most common mistake investors make generally?
I think the most common mistakes is following the herd and just doing what everybody else is doing and not making sure that an investment is appropriate for your institution, and making sure that the analysis that someone else has done is not appropriate for you or is not congruent with the way you think about the world. I think there are a million ways to make money. I think there are a million strategies that can work. Not every investment is consistent with your strategy. And so I think there's a lot of herd mentality, and that's a huge mistake that happens.
Let's suppose your oldest child came to you and said, I made $100,000 by doing something creative. I invented a company, or I did something. I have $100,000. What should I do with $100,000?
I would tell her to go to a professional that deals with retail investors and make sure she invested. I would also, quite honestly, she needs to invest in her future. Young people need to invest in their future. And for different young people, it's different things. My daughter wants to be a lawyer. She should pay for law school, right? That's a great use of that capital. Other people aren't sure what they want to do, and they need to park it someplace while they think about it. They should go to a talented individual who is very good at retail investing and have them invest their money for them until they figure out what they need to use it for.
And if somebody was looking to invest in the area, let's suppose the person with $100,000, is there one thing you would say absolutely do not invest in? This is something you should absolutely avoid. Is the worst thing to do with your money right now? Is there one area like that?
I think the answer to that question is, do they need that $100,000 to live? Or is that $100,000, whether they keep it or not, it doesn't matter. If you need that $100,000 to live, you should not be investing in cryptocurrency, right? It is way too volatile. If you don't need it to live and this is just play money, perhaps you should invest in it. It depends on your risk tolerance. I think that there are absolutely investments that certain people should not be doing. But many of those same investments, somebody who has a really high risk tolerance, they should take a chance.
Now, compared to your time when you went to Wharton, Harvard Business School, and early in your career, do you think women have greater roles in the investment world than they did before? And do you think that's going to get even better than it has been?
I think we are increasingly seeing that the way many people, a lot of diverse types of people, think about the world is different than the way traditional investors have thought about it. And I think whether it's true or not, I mean, it's hard to tell. The perception is that women think more long-term than men, and they are more, they think more about investing as opposed to transactions. It's debatable, I don't know, but what I do know is that you invest according to how you came up and your experiences, and they have a diverse set of experiences that are different than some of the more traditional investors have had. And so there's an opportunity for performance.
What's the appeal of the career of being an investment manager for a university? Is it one you recommend for young people? Should they come up and say it's better than private equity to go into this field?
This is the most amazing job that exists. I know you think your job is great. My job is far better. We are obviously a wonderful institution that does great work that a lot of people want to support. I don't think there's very many, if any, managers out there that we wouldn't be able to get at least an audience with when we're trying to do research and due diligence, different opportunities. All of that is usually at our fingertips, where we are able to talk to all sorts of people that growing up I never imagined I'd ever have access to talk to. We can talk to governors, and we can talk to regulators, we can talk to presidents of other countries, and we have a wealth of expertise here in the university. So every day you learn a little more. Every day you get to make an impact on an institution that is doing great work, and it's mission-based, and it can feel wonderful that this is what you're going to, what your work supports every day. And I can't think of a better job, right? Every day I'm smarter, and every day I feel good about what I'm doing.